I'm Kyle Malnati, your host of the Calibrate Real Estate Podcast. At Calibrate, we exist to help people create generational wealth through real estate. My personal mission is to encourage, empower, and educate you by sharing best practices from business leaders that are proven winners. Broadcasting from the Mile High City, thank you for tuning in to the Calibrate Real Estate Podcast. I'm your gracious host, Kyle Malnati. Our esteemed guest today is Chris Larsen. Chris is the founder and managing partner of Next Level Income. Chris wrote a book. I mean, that's amazing, and I can't wait to talk to a true authority on the subject of Next Level Income. We're going to have a great discussion about a topic that I'm passionate about, multifamily investing. Chris, welcome to our show.
Oh, thanks. I really enjoyed getting to know you a little bit more before the show. We have a ton in common. I'm excited to talk to you today.
I am as well, and I agree with you. It's just fun how you do research about each other, and as a podcast host, you're a podcast host, I am as well. That's a natural thing. We're Googling, we're searching each other's websites, asking each other questions. It's this dynamic flow, and it's like, man, we're kindred spirits. It's like you're over in Asheville, North Carolina. I'm here in Denver, Colorado, and there's so much similarity. Your wife grew up in Littleton. She went to CU Boulder, which is awesome. And so now that you're in the position that you've been investing for over 20 years. You know, sometimes it's a little bit difficult to maybe think back all the way back to the start, but you started buying your first rental property, a single family rental, when you were 21. And you've spent the last 20 years owning, managing, investing in multifamily investments, syndications, et cetera. I started my real estate brokerage career as a 22-year-old, working for my wife's cousin, learning everything, the school of hard knocks, running into walls, doing the whole thing. So what in the world possessed you to buy a rental property at 21? How'd you get that start, Chris?
Yeah. So Kyle, thanks for giving me the chance to talk about that. And if you're listening, you want to learn more, I talk about it in my book, which you can get on our website. Kyle mentioned the book, nextlevelincome.com. It's nextlevelincome.com. Just click on the book link. If you put your address in, you'll get a free copy as well in the mail. So I was in college, I was racing my bike, and I wanted to be a professional cyclist. And for anyone that knows anything about the sport, they know that it does not pay very well. So I always thought, well, I don't want to be poor. And I was always kind of an entrepreneur, Kyle. I had wrapping paper that I sold when I was 12. I picked up a paper route, and then I had I hesitate to say lawn care business, but what I would do is seasonally, I would do things like rake leaves, and my stepfather would help me by bringing his dump truck. Since he was a contractor, I'd load it up. We'd go to the dump together. And since we lived outside of Annapolis, Maryland, a lot of his clients had high-end homes. So these big yards, I'd spend a weekend, like, $300, $400, $500 in a weekend. And then during the winter, I would shovel driveways. So I had this entrepreneurial streak, sold lofts in college, and the family that introduced me to cycling. I'm still an avid cyclist. I raced for 20 years. He gave me a money magazine, and it talked about starting a Roth IRA. Roth had just come out, and the magic of compound interest. And it had this upsloping line. And I was like, man, I gotta start investing. So I started an account, started a Roth IRA, but then I started day trading. So I was day trading. I was, some months doing phenomenal, like doing really well. But it was also very stressful. And during the process, I was laying there at like 3 a.m. one morning and thinking, okay, there's got to be a better way. So as I started to look at other investment options, I read 250 books, and obviously real estate is one of the options out there. My parents had a few rental properties, just single family rentals. And I thought, you know what, this is less stressful. I have more control, and I can employ a lot more leverage. And I was certainly using sometimes margin account in my trading account, which also led to some big losses from time to time. So I bought my property at 21. And from then on, I put a plan in place to build a portfolio where I had $10,000 a month coming in. I figured at that time, as a 20, 21, 22-year-old, if I could have $10,000 a month after tax and expenses coming in, that I could basically do what I wanted with my life. And that was the path that I started on until we eventually transitioned into multifamily.
Wow, that's an incredible story, an incredible journey, and 250 books. So this is not a question we necessarily prepared for, but it's a question I've asked a lot of influencers and people that are making things happen. And I think that that's the message of Calibrate Real Estate is it's an iterative approach. I'm an avid learner. I'm curious about a subject, so I'm going to go out there and become a student. And I feel like people learn far more outside of education in a formal environment, because that's you picking and making this your master's in real estate. And obviously, I know you got an MBA and completing a degree in biochemical engineering. I mean, you're a smart guy. At the same time, it's just important to remember that anybody, anywhere, can sit down and start learning about a subject and become an expert, become an authority. Once they've read probably 5 or 10 books on something, I mean, you start to become an expert. And then there's that theoretical knowledge that then translates into application. So I've got to ask 2 follow-up questions to that, because it just hit me in my tracks here. 250 books. What are some of your favorite books? Because I believe that all leaders are readers. So what are some great book suggestions that are just on your top 10, your top 5 all-time favorites?
Yeah, so one of the books that kind of inspired me was called Buy and Hold. And I don't even have it. I have a bunch of books here behind me on my bookshelf, but Buy and Hold, it really talked about, it was about residential real estate, but really how, go out and buy real estate, and kind of like a get rich slow process. Also kind of looking behind me here, some that are still on my bookshelf. The Secret Life of Real Estate and Banking is a phenomenal book. I have The Intelligent Asset Allocator, anything by Benjamin Graham. Really, if you look through that, everything that I talk about really focuses, Kyle, on kind of the theory of value investing. I talk about how we basically employ the Warren Buffett strategy in real estate, which is go and buy properties or businesses like Warren Buffett does, that you can operate more efficiently and improve through, whether it's through resources, individuals, or capital.
So the next follow-up question then obviously begs the question of, okay, if you're going to be reading all of these books, what was that journey like for you as you're picking up each book? And then I kind of previewed this right before I asked the leaders or readers question. At what point do you get out of theoretical and start actually operating? And you had mentioned you'd experienced some losses, and that's part of the journey too. So how do you wrestle with this theoretical knowledge versus applied knowledge, or knowledge from the streets, if you will?
Yeah, so I kind of have a strategic mindset, and if you look at my personality, and there's different profiles out there that you can look at, but one of the strength finders of the Colby Index, it kind of puts me as kind of a strategic thinker. So for me, what I do is I read a lot, I do a lot of research, and then I develop kind of my thesis, if you will. So I typically, I don't know, within a matter of, say, a few months, I can determine, if I'm going to spend ample time on that. And then I kind of, after I develop that thesis, I'm going to find the right individuals to learn from, and I'm going to keep learning. So those 250 books, a lot of those were about, financial markets. A lot of those were about real estate. A lot of those were about different types of investing. My goal today is to, I read 2 books a month, sometimes an audiobook, sometimes a paper, an actual paged book, and then you have a lot of podcasts and stuff that's folded in there. So I think, for anybody that's listening, if you're listening saying, okay, I want to get started in this, make sure you're comfortable with the strategy. People come and say, how do I get started, Chris? And I said, the first thing to do is look in the mirror and figure out what you enjoy and what you're good at. And then if you say, hey, I want to be involved in real estate, but I really enjoy swinging a hammer, I have some skills in that, maybe you want to do fixer-uppers. If you're more of a financial guy like me, I gravitated more towards the commercial side of things. And what I did was I looked at the demographics. And once I saw that the fundamentals favored, in my opinion, multifamily for a long period, I went with that. So that's the other piece of it. I like to bet on long-term trends. So some people are short-term traders. I was talking about day trading. That's not my personality. I like to pick something that I can do for 5 to 10 years in a predictable fashion and put a lot of energy into building relationships in that strategy and go with it. And then once I'm comfortable with that, I'm starting to execute efficiently, I start to look at the next 5 to 10 years. So that's something I'm doing right now, is determining, okay, what is going to be the next big piece of that? You did mention like what was kind of the catalyst to all this, Kyle. And, if you think about individuals, like what motivates us, one of the things that I've found through the loss of my father at age 5, the loss of my best friend when I was 19, he was 18, is that it's really hard to value time as finite if you've never experienced significant loss. And I read, I forget if it was Malcolm Gladwell or one of his colleagues kind of in the space, but they talk about how there's a high correlation between loss at a young age and success. And I read that and I thought, that's crazy. Like who would have thought, and who would wish that on anybody? But when I lost my best friend, I'll never forget, just looking in the mirror or maybe out on a bike ride one day and man, I'm never going to let an opportunity pass me by, whether that was asking a girl out or if a friend said, hey, let's go raft the Grand Canyon, that I did with some friends a couple of years ago. And it was so anxiety producing to think, I'm going to spend 2-3 weeks away from my businesses and away from email. It's crazy how addicted we are to the digital thing. But that was the catalyst for me. It was, okay, what do I need to do to have freedom in my life to not only live the best life, but also have the best experiences and really, honor what I consider to be the talents that I've been given. So that's really what kicked it all off and ultimately called me to quit cycling and focus on investing and, the other endeavors that I've pursued over the past 20 years.
I'm so happy that you shared, even though it's maybe a sad or somber, and people that haven't gone through loss of someone that's close oftentimes try to avoid that discussion. And you were upfront with me when we were preparing for our show and asking about my brother Billy, but then also sharing some of your situations. And those who are maybe new to our show will know that I talk about my brother who passed away 9 years ago now at the age of 24. And that'll be something we can talk about later in the show. We'll tee that up. But I think it's really important to have these moments where someone that's important to you is gone. And what are you going to learn from maybe seeing that life is finite and that you have one chance, one opportunity to make things happen. I'm so grateful that you shared those thoughts. I also want to park on something that you just mentioned right before that with Benjamin Graham and just your strategy of investing and just kind of the authorship. This is a shout out to a client of mine that I interviewed back in 2015 for a different show that we were doing on YouTube. And this gentleman's name is Josh Mullins, and Josh works for a large family office that invests in multifamily assets here in Denver, but also their company does investing across the United States. Josh had encouraged me through reading similar books to you that most investors approach the market as a speculator instead of as a savvy investor. And what he distinguished there is, and you said it too, Chris, is that there's a big difference between short-term and long-term mindset. So how do you approach this get rich slow? How do you approach this build wealth? And those that listen into our show know that Calibrate's mission is to help people create generational wealth through real estate. And that is something that takes 50, 75 years at times. And so as you're working with people to create multifamily investments and you're focusing on generational wealth, how do you encourage them that this is going to take some time? This is definitely a tortoise and the hare type of discussion.
Yeah. So I have a young gentleman I'm coaching, and to kind of counter that, he just got a deal. It was basically a zero down deal that he structured, and he created about $400,000 of equity, like boom, yesterday with that deal. So you can certainly make significant money, but you think about, okay, let's say he cashed out of that 400 grand, he pays taxes, he walks away with maybe say $250,000. That's not bad, but that's not generational wealth. So walking back, I spent 15 years of my life in the medical device industry. I still have a hand in that business. And the reason I got into that business, Kyle, was because of demographics. So I wanted to be an investor. I didn't have a lot of money. I thought, okay, how can I go out and make enough money to become an accredited investor, make more than $200,000 a year? And I wanted to go into sales. So when I looked at different sales opportunities, I was reading some different books. Harry Dent is another author, Harry S., which some people think he's kind of crazy with some of his predictions, but at the core, he's a demographics guy. And what he talks about is that demographics fuel financial trends. So I looked at careers that would be fueled by, at that time, the baby boomers. And think about it, orthopedic implants, the baby boomers, very active, wearing out their joints, living long. That was a great industry to go in, very stable. So I moved into that industry. when I was going through kind of a revamp of my portfolio back in 2012, and that was also inspired by kind of a introspective period right after my mother had died, to our earlier points. I found was the multifamily space was being fueled by, at that time, the millennial generation who were renting. Now it's actually fueled as much by baby boomers who are going back to rent, which I'm sure you know. I see you smiling. But I thought, wow, this is like demographic trends. So I follow the demographic trends because I know those are going to be big time shifts. Now, does that mean we don't have big hits, from time to time when it comes to, making a lot of money with a really good deal? No, like sometimes you get lucky, but if you're always trying to hit a home run, those players, if you're a baseball fan that hit a lot of home runs, typically strike out the most as well. I favor more like Moneyball strategy. So Michael Lewis is another one of my favorite authors, and he wrote Moneyball, and he talks about kind of using statistics and thinking about it a little bit differently. And okay, do you really want to hit the most home runs, or do you want to be the person or the team that gets on base the most often in the most consistent fashion? Those are the teams, those are the individuals, those are the businesses that over long periods of time do the best because you don't have what's called variance drag. So if you have a chance of making, say, 30% one year or 0% one year, your average return is 15%. Well, if I you, would you rather have a 30% or a 0% return, or a 10% versus 20% return? Both average 15%. Which one are you going to pick? Some intelligent people are going to say the 10 and 20 because you're going to have less variability. And I would much rather make 10% one year, 20% the next, 10, 20, 10, 20, than 0, 30. Do the math. If you make 0 one year, then make 30, you're at $130,000. If you make, $10,000 one year, and then you 20% on top of that, it's more than $130,000. So that's over time. Being an engineer, I knew that was the strategy that I wanted to do.
That's amazing, Chris. Personally, having gotten a degree in finance and then spent, the past 15, 16 years working in a financial services oriented piece of real estate in the commercial real estate market here in Denver, I've never heard of variance drag. It makes a lot of sense intuitively. It makes sense to me. Where did you pick that up? And what if someone's heard that and they're like, man, that makes so much sense. There's so much clarity there. But at the same time, my mind's kind of blown a little bit. I've never heard that before. Where'd you pick up that concept? And then how do you use things like, kind of the Moneyball concepts and variance drag to really focus, on having demographics work in your favor?
Yeah. So if you're listening and you're like, it's the first time you've heard that, there's difference between, so an average return is really, in mathematics, it's called a mean. So your mean is your average in mathematics. In finance, we have two different things. We have an arithmetic mean and we have a geometric mean. So a geometric mean would be your IRR, your internal rate of return, or basically what would the compounded return be over a long period of time, versus an arithmetic mean is what is your average return over a long period of time. And if you don't have to go and drill into this to figure it out, all you need to know is that if you have the same average return of two investments, the one that has less variability, less volatility, is going to have a higher internal rate of return, all other things being equal. And that's really what the variance drag is pulling down that geometric mean from that variability. That's why people that quote the average return of the stock market at 8% or 10% or whatever it may be over the time period versus real estate, they don't understand that basic concept. And it's a fairly advanced concept, but really, if you go back and you look at it over a period of time, it's pretty basic. And that's why the most affluent families, even if they've never, created wealth in real estate themselves, typically put 20, 25%, 30% of their money in real estate, as well as the big foundations or the endowments of schools like Yale and Harvard, because they know that the predictability, that stable income producing asset like multifamily real estate, for instance, is going to even out the highs and lows that the stock market has. And over time, you're going to get a higher return, lower risk in your portfolio. And I talk about that in one of the chapters specifically in my book for that reason.
Well, and the thing that having a degree in finance and spending a lot of time after college learning about financial markets, both here locally, microeconomy, but then also just financial thought. One of the one of the great things that I think many people in real estate approach is that we all kind of come into the business with a little bit of a broken risk meter. And risk in real estate is defined as a beta. And most investors don't underwrite risk in their investments. And so while it might be exciting to talk about, and I was actually sitting down with a financial advisor, and this is a good buddy of mine. My goal is not at all to poke fun or do anything, but they were commenting about how this particular individual stock was yielding X amount of return in the tech industry this year. So without, I want to keep our interview evergreen here. So it doesn't matter what year it is, but you can have any one of those stocks that are like 30%, 40% up. But what ends up happening is you also have to be okay with it's down 25% or 15% or whatever. And you've got everything zigzagging all over the place. And it's this constant concept of what do you want to be, the tortoise or the hare? And it's the stress that's involved with watching that go up and down versus the steady eddy, slow progressive. And you can see over my shoulder here, our Calibrate logo has that very steady upward and to the right. Every single year, we're going to iterate. We're going to get just slightly better. And this is going to be the little engine that could. So Chris, I'm so happy that you gave us some high-level thought about that, but also kept it really simple, which I think great financial minds do really, really well. Now, since 2016, you've been actively syndicating deals, and you've been involved in over 150 million, by the time someone listens to this, it could be 200 million deals of real estate acquisitions. As a real estate investor, and I'm speaking to the brokers that are in my own company, I'm also speaking to the other people who are maybe embarking on that journey of investing. This is not specific advice, but just kind of what are some of the things that you think about, look at when you're going out there underwriting a deal?
Yeah, so you're right. We're closed on a $57 million deal, so we're going to eclipse that 200 million here very shortly. But again, the big thing is look at demographics. One of my favorite to look at is the United Van Line's annual moving report, and they talk about what states that people are moving to and from. And Colorado is a great state because people are moving from like California and higher expense states out in the West to places like Colorado, from the Northeast to places like the Southeast, which is why we're such big fans. Moved to Asheville because of the demographics, because of the trends. I figured, hey, why not live in an area where more people are moving to? That makes it easier whether you're running a business or owning real estate. So that's number one. Number two, after you pick a strategy, so I always talk about there's a few different types of risk. There's operator risk, there's market risk, and there's deal level risk. So from a high level, pick a big market that people are moving to. When you drill down, as we kind of filter down, you want to look at average income in an area. We want to look at job, not variability, but employment variability. So you want a lot of different employers in an area. So that's going to be more robust than like a one factory town.
Yeah, like a well-diversified job market. In Denver, we were absolutely in trouble in the 80s because we were very, very focused in the energy sector. And so when, we had all these different issues, tariffs, all these sort of issues that really affected the oil and gas market, Denver was called a see-through city. There were all these brand new office buildings that were completely vacant in the 80s. And so what the economic councils were doing here and different development partnerships were really focused on the 90s and the 2000s. Those 2 decades in Colorado and in Denver Metro were making our economy a more diversified economy with different balanced job sectors. And so now we've got all sorts of different things, healthcare and craft breweries, and obviously you've got other different types of things, real estate, construction. It's not just oil and gas. And so I definitely agree with you. A diversified economy is a really important demographic to focus in on.
Yeah, absolutely. So then, I'm going to have to skip through a lot. And again, you can go through my book and I talk a lot about all the different metrics. But one of my favorites when you get down to the deal level, so you're looking at deal in a multifamily specifically, you have to consider the current economic environment. So, we're in 2020, we have COVID. You look at, okay, what's going to happen? One of the metrics that we really, we didn't introduce, but we really elevated in our algorithm, if you will, was house for the job. So we basically have a matrix. When we do our underwriting of a deal and our due diligence, we say, okay, what jobs are high risk? So the deal we're in process of acquiring right now, 93.4%, or it's 93.2% of the residents have low risk employment. So that means, they're in sectors like healthcare, like education, sectors that aren't going to be affected by COVID. The other 6.8%, they are retail workers, they're service economy workers, they're in food, for instance. So we want to see, okay, what percentage are going to be at risk? It's going to help us determine, the variability of our rent collections with respect to that. So again, I think you have to, if you're an investor, if you're an operator and you're out, go high level first, make sure the overall trends work, and then drill down and then get as specific as you can and apply current market data as well as current economic environment data, like the COVID situation we have. That's going to allow you to really figure out how you can decrease the variability of your returns for investors.
Chris, I'm really a big fan of the concepts and the mission behind next level income. And I want to take a moment. I want to take a moment just to talk about your book before we get into the end of our show. And our avid listeners will know the last two questions that we ask everybody. But before we leave that topic, you had shared with me that you really enjoy working with individuals to help make them money, to help them keep more money and ultimately grow their money through what you call the holy grail of real estate. And that your mission as an author was to really help others achieve financial independence. What does financial independence mean to you? And if someone's sitting there and they're broke, they're down on their luck, or they might just be young, aspiring, they're young, they're humble, they're hungry, they're smart. They're that person that's like, they're going to achieve something, but they don't quite know what the next step is. What does financial independence mean, and how does someone achieve that?
Yeah, so first and foremost, Kyle, I think financial independence is the ability to live the best life that you can and get the most value out of your life. I define it personally. My personal mission was to get my passive income above my basic monthly expenses. And then that gave me the freedom to chase after certain passions and pursuits that may take more time, or I may have to pull away from some of my active money-making endeavors. So for me, from a high level, it's being able to do what you want to do when you want to do it. That's true financial independence. But for me, it's also, from a money metric, it's okay, when can you achieve passive income above your basic expenses?
That's great. And congratulations for writing a book. It's something I aspire to do. Becoming an author, I mean, literally it's derivative of the word authority. It's got to be such a mountaintop experience, and can't wait to see what else you have coming down the pike as far as different concepts and thoughts. All right. So our final two questions that we ask all of our guests. Chris, you ready for this?
Let's do it.
All right. So the first comes from a song that I've always really enjoyed and resonated with. And it's a song called Dear Younger Me. The author of the song, the writer of the song, is writing themselves a letter when they've lived some life, maybe they're in their 40s or so. And I've dubbed the song, now this isn't in the song, but I've dubbed it The Advice You Wish You Knew When You Were 22. So if you were writing a letter to yourself, or if you're coaching someone that's maybe in their early 20s, like you and I were when we got started in real estate, what's the advice that you wish you knew when you were 22?
So I think the advice that I would give my 22-year-old self, and I largely followed this, Kyle, it would be find someone who has achieved what you want to achieve, someone you respect, somebody in the area of expertise that you want to go in, if it's real estate or medical device sales like I was in, or sports, whatever it may be, and become an apprentice. Hire that person, try to find a way to work with that person, and bring that person value, and then learn from them. I think that's one thing I could have done better is I found those people, but then I really didn't, I guess I kind of assumed that they didn't want to give me their time. Whereas now what I know is that people that are successful, that see the traits of success in younger people, they want to help people like that. So what I would say is find somebody that you can emulate, and then try to work with that person. And one of the great ways to do it is see if you can bring them value in some way.
That's such a great piece of advice. And I hear the two concepts of mentoring and modeling. When you're an apprentice, you're working with someone. You think about like old school medieval times, you're a blacksmith or a coppersmith. You spent 20 years, 30 years being an apprentice, and then that master at some point passes along that craft to you. And it doesn't happen overnight. And I think it's interesting. You had said that, you can hire that person, in sort of a coaching application. I also believe that you can work for that person and adding value for them. And that is a wonderful, very dignified exchange of, look, if you're wanting to be a master in real estate investing, go work at a grunt level, at a base level income for someone who's already doing it, that you can learn so many different things from. And there's been so many guests in our show that have done that have started off working for someone in a very entry level position, really learning everything at their right hand. And I did that. I know that you've done that as well. So it's great advice, Chris. Last question that I ask all of our guests, and this is tying into our pre-interview questions that we were talking through just to generate some rapport with each other, but then also some things we talked about. You've experienced loss, some people loss, relational loss in your life. I have too, with different clients, different friends, obviously my brother that I talked about, Billy. One of the more impactful ones recently was my career coach, a guy named Chris Oakley. Chris passed away last year in a hunting accident, and it was a real tragic situation at the age of 37. And we were the same age. I'd been working with him for 5 years as my coach, and I wasn't there when that happened, but it was just one of those things. You get that news, and it's someone that helps you grow your business, always believed in me, always was someone that was there when I was struggling or confused. And I haven't shared that detail of it with a lot of my guests, but I can tell that you're kind of connected to this concept of legacy in everything that you do. So Chris was actually interviewed several times for this podcast. One of the most impactful interviews I had was episode 5 with Chris. And Chris shared the answer to that Dear Younger Me question. Chris shared that when he was in his 20s, he was part of a mentoring group, and one of the exercises that they had to do was read a book called The Principle of the Path by Andy Stanley. And in the book, Andy Stanley encourages his readers to write their own obituary. And so the question that I ask all of our guests now, as a way of a very appropriate memorial and tribute to Chris Oakley, is, what would you want someone to write if they were writing an obituary? Or even maybe more personal, if they were delivering a eulogy, someone that's a trusted family member, someone that's very close to you, and they were delivering your eulogy, at this celebration of life when Chris Larsen passes on. What would you hope are some of the themes that they would share in either an obituary or a eulogy?
Yeah, I appreciate you sharing that story, Kyle. It's very impactful in a number of ways, and it's interesting because my professional coach, he asked me to write my obituary earlier this year. So I actually pulled it up here while you're asking about that. And, instead of just sitting here and reading it, there was a couple things that really stood out to me. I think the first one is being a passionate father, husband, and competitor. I think passion is huge in my life. It really, it's kind of the juice that gets you up in the morning and what drives you. And then the other thing is my company, Next Level Income, helped thousands of people live their best lives. So I think from a personal level, it's the passion to explore new opportunities, new experiences, friendships, family, and spend the time developing those meaningful relationships. And then ultimately passing on the knowledge to those that, can continue that legacy and spread that in a meaningful way to a lot of other people. So those would be the two themes that I would want to be remembered for.
Chris, thank you so much for your time with our Calibrate real estate audience today. One of the things that I think is so gratifying by working with an author is that you've spent, it's got to be at least several months, if not a couple of years, coming up with a book that you've written called Next Level Income. And I'm sure that there's people out there that, whether they're listening in on their Apple Podcasts or they're listening in on some other thing, they could just very simply probably say, hey, Alexa, how do I buy Next Level Income by Chris Larsen? And boom, it's there. And you know what? I'm sure that there's an Alexa somewhere in someone's area, and all of a sudden it's turning on buying Next Level Income for everybody. But if they want to get Next Level Income, it's pretty simple actually to go onto your website. And what will they learn when they read that book?
Yeah, so certainly you can go on Amazon or ask Alexa to pick it up here. And my Alexa is going to be going off here in the background. But yeah, listen, if you're listening today, check it out, nextlevelincome.com. Click on the book link. You can get a free ebook right away. I'll send you a paper copy. We actually have our Audible version that I'm finishing up as well. So you can get it on audible.com. What you're going to learn, and we talk about how to make more money, keep more money, and grow your money. So really, if you want to learn about ways to make more money, you can check out our podcast on the show. We try to bring people on that have ideas that help you make more money actively. We bring on people like tax strategists to help you keep more of your hard-earned money so that ultimately you can grow your money. And what you're going to learn is a little bit more about my personal story that we talked about today, but also why I call multifamily real estate the Holy Grail, which I that term from Ray Dalio, which if you know Warren Buffett, you should know Ray Dalio. He is the operator of the world's biggest hedge fund, Bridgewater Capital, and by some accounts, maybe even more successful than Warren Buffett. So check it out. Feel free to reach out to me as well if you have any questions or would like to follow up on anything.
One of my clients bought me the book Principles by Ray Dalio, and it's meaty. It's thick.
It is meaty, and it is certainly meaty, but I think it's worth the read, especially if you're a business owner. It's really the bedrock, some things that you can build, a sustainable business on.
All right, so make sure you say, Alexa, order Next Level Income by Chris Larsen. All right, well, I also have to say, anybody that's been listening into our podcast for one episode, 40 episodes, or over 140 episodes, thank you. I'm sincerely grateful. Please rate, subscribe, review. You can also say, Alexa, play Calibrate Real Estate Podcast by Kyle Malnati. As I think about just how much this podcast has grown, people like Chris really make it happen. Chris has invested his time and energy to spend an hour with me. That's not lost on me. You've invested as you're driving, as you're on your morning run, as you're walking with the dog. You've invested time to have me come into your life, and I'm just so grateful for that. I hope that you're constantly working through the concept of just making your life better on a daily basis. That's what Calibrate is all about. So for our guest, Chris Larsen, for our podcast producer, Kayla Davis, I'm your host, Kyle Malnati, and as I love to say, we will see you around the neighborhood. Thanks, everybody.